All right, I am in Ica, Peru. This is the second place that I'll be staying at during my trip. Ica is a desert, and I'm going to spend more time tomorrow actually exploring, and I'm going to get some pictures of some of the cooler places around here. The desert, it's 90 degrees or 93 degrees. It's and completely sunny, and actually a little bit feels a little bit humid. I don't know what's going on there, but it's very hot outside. So I'm going to take some time midday here and make a video for you guys. This is my Airbnb. It's kind of a nice little place. This is $40 a night, and uh, you can get something much cheaper than that if you wanted. But this is just what I went ahead and went with. What I want to talk about is Monday's price action, and also just talk about some of the sell-off that we're having. So, start off, the S&P is basically in correction territory right now. It's basically, and that's a 10% pullback from the all-time highs, and that's basically where we're at right now. It's at least partially, probably mostly due to tariffs. There's a bit of a tariff war going on right now. And I thought this was an interesting stat. It's been 340 trading days since the S&P last corrected, which is an abnormally long time. According to this firm, the average time between corrections has been about 173 days. So you can never really call yourself overdue for a correction, but in this sense, we've doubled the time of the average correction. So considering we have been so strong since the election, and now we are getting these tariffs, it makes sense that the market is starting to have a bit of a pullback. And here's the daily chart. You can see this fairly sharp sell-off we've had here. Go back and watch that video I made about when I was talking about when the market was right around here, and I was talking about reasons why the market might sell off, and I was showing prior examples that looked like our current price action here. And well, this sell-off has really been great, and that video turns out to have played out very well on providing a reference for what the market might do, and it's pretty much done exactly what was discussed in that video. So I'm going to link that and consider watching that. Monday's price action. Monday was, I think, the biggest sell-off since 2022. I'm pretty sure I saw that's what that was. So Monday was a big bear day. It started with a big gap down. When you have these big gap downs, it increases the chance of a trend day. When I was trading this, something that caught my attention that I made sure I wanted to bring up. What some bulls will do is they'll be buying above this bar here. And I'm not necessarily marking this as a great place to buy, although for some, they can take that and that'll work out fine. It's a bit of it's a wedge pattern, and it's on the open, so the opening has a decent chance of reversing, and it's also far from the moving average. So there's multiple reasons where it's okay to buy above this for a swing trade, and buying above it try to go for 2 times your risk, buying above it to come back and for a test the moving average. So the point I'm making here is some people will be buying above this. There will be stop orders to buy here, and people that are long all through this. So I want to take a few minutes and kind of really focus on what's going on right in this area. So 3 bull bars up. Most of the buyers here are trying to get a profit around here. Their take profit order is going to be around here. It's it's not too far up. It's still going to be below the moving average, and it's an opening reversal swing trade. So a lot of buyers that are long here. After we've gotten 3 bars like this, 3 bull bars, all closing above their midpoints, and also a gap with the high of this bar and the low of this bar, the market is likely to get a second leg. So we're going to have first leg, then some sort of pullback, and the market's likely to have more higher prices up. So when we're looking at that, when the market's having a good chance of a second leg up, then look at this bear doji. So it's a bear bar with a big tail on the bottom. Probably not too many sellers below that, because one, it's a weak signal bar, and two, after these 3 bull bars, we're probably getting a little bit more up. So why sell here if they can sell higher? And because of that, it ends up there's going to be more buyers below this bear doji. So there's probably going to be more limit order buys below here than there would be stop order buys. Stop order sells. More limit order buys here than there would be stop order sells. So bear doji, probably still going to get a second leg up. Then we get this larger bear bar, and that's better for the bears, but still, at this point, we're probably going to at least get a test of this close. And let me move my screen over, make it clear. All right, that looks good there. So after this bull bar, that could be the second leg up. So first leg, pull back, second leg, testing the close of this highest bar here. To me, that's good enough for a second leg, but market did end up getting a little more up. And where is the market going up to? It's going up to the moving average, and it's going up to this swing trade. So bulls that bought here, they're getting out at 2 times their risk, and they're also getting out at the moving average. And so it makes a lot of sense that the market reversed at this price. You had a lot of people that were long, and it was time for them to take profits. And you had people that were eager to get short, because we've had 2 legs up now. We're at the moving average. We're at this profit area. We're in a bear trend. So it makes a lot of sense to be selling in this area. Then we got this bear bar, and after 2 legs up like this, there will be a lot of traders starting to sell below this, and swing trading, and they're betting on a bear trend. They're betting on lower prices. When I was trading this, I didn't actually sell here below it. I was wanting to wait for a follow-through bar, maybe a bar somewhere right around here, and sell below that. Ended up not getting it, and ended up just basically going straight down. So, I didn't enter there. This trade, so I like the idea of selling below this bar here. It's after this head and shoulders pattern we've had, left shoulder, head, and right shoulder. And even though it's coming in near these lows, I think there's a good chance that the market is going to be breaking out here and continuing lower. And that's going to be the same for many of these bear bars that we end up getting. Selling here or selling below this bar. And when you're selling in a trend like this, you have 2 options. One is to put your stop above the bar and then swing trade from that, or you can put it above the major high. So the major high in this case is actually way up here. So you take which one you prefer. You prefer your tighter stop, but your probability is less. You're going to get stopped out here and then here until you finally get a swing trade here or here. Versus if you see that you're in a bear trend, and then if you put your stop above the major high, as long as it stays below that major high, then you're still in a bear trend. And so your win rate is going to be much higher if you put it up here. But then, of course, when you lose, you're going to have a larger loss. So what's better? It really comes down to your personality. You can trade larger and put your stop here, or you can trade smaller and put your stop up here. And it's going to be like when you do lose, you're not going to be happy losing that large amount. But the benefit of putting your stop way up here is that you won't actually take that big of a loss. You'll get out before the market comes up all the way up there. You know, you'll see a reversal happening, and you'll find reasons to exit. So you'll exit above some bull bar, like somewhere over here. So just because you put your stop up there doesn't mean you're actually going to let that get hit. That's just protective. It's there to avoid having some catastrophic loss. If something happens, like if your internet goes out, then the stop is there to protect you. And really, instead, you're going to end up managing the trade and getting out once the market's showing signs of reversing. So just because you have your stop up there doesn't mean that's actually where you're going to be exiting. If you put your stop closer like this, you're going to have to accept a higher rate of loss. And you can see, if you sold here, you would have gotten stopped out above it. Sold here, would have gotten stopped out above it again. And then finally, that's when the trend started to continue. So, me personally, I do usually put my stop above that bar. And I try to be more selective and wait for multiple traps like this. So bears lost here, and then bears lost here. Once you see it a couple times, then it's more likely that the bears are going to start working. Because if the bears are getting stopped out, but the market continues back down, that means the bulls are getting trapped. So the bulls bought here, trapped. Bulls bought here, trapped. Never really got above the moving average. Never really reversed the trend, and then at some point the bulls just give up, and that's what happened. So I'll keep on marking these, selling here. You know, so one swing trade here would have offset your losses you might have taken here. If you took this short here, let's see, 2 times your risk. So if you took that short there, you would have been out actually before this market even pulled back up. So you would have had about 27 points of profit just from that one trade. So taking a couple losses here would not have hurt you that bad, and then you'd have been back on the right side taking this short or shorting here. And you can see what my idea is. It's basically shorting below bear bars, below the moving average. And if you're doing that, if you're staying on the right side of the market, then it's going to be hard to really. It's going to be hard to really hurt yourself. Yeah, you might have some losses, but you're going to be able to live to trade another day. Market continued selling off, and basically all these little pullbacks I would consider selling below those. You can consider going to a lower time frame, looking for trying to get a more precise entry. Looking at this bar as it's pulling back to the moving average, look for a bear bar on like a 1-minute chart or a 2,000 tick chart, and I think that'd be good. So market is about at its 10% pullback, and that's an area where people start to buy. So anyone that has cash on hand, I've heard of investors that they just wait for the market to pull back 10%, and they just put in half their cash or something like that. If it pulls back another 10%, then they'll put in another amount of cash, and that's all they do. And someone that does that is going to do very well. They're going to do better than almost anyone else by doing that. So, and I bring that up because since we're at 10%, probably some buyers would start stepping in at that 10%. If it goes down to 20%, probably more buyers would start stepping in. So, those are just kind of key psychological levels where people begin to enter the market. That's all I'm going to talk about here. Thank you guys for watching. If you have questions about the price action here or about Peru, let me know in the comments, and I'll get back to you guys. All right, see ya.